Good afternoon, and welcome to all our viewers today and our clients. And I really look forward to sharing my thoughts about the market, which are actually quite positive and maybe surprisingly so for a lot of you. But let me, share my thoughts as to why I have turned positive after being quite negative for a bit. Okay, so let me begin by sharing my presentation. Okay. So, as you know, 2024 was a volatile year for the stock market. And as Serge has shared, in the third quarter, we were given the false hope that, it was the beginning of the Philippine market's recovery after um, moving, I would say, negatively for the past 4 years or almost 5 years, starting in 2020. But unfortunately, in the third quarter, in the fourth quarter, stocks fell again, disappointing uh, investors. And I'd like to share the reasons why. I mean, in a way, we weren't surprised because we were already talking about the potential third quarter GDP disappointment. And for us, it was because of the high inflation rate and the negative impact still having some lag effects. As you can see, the third quarter GDP growth disappointed at 5.2%, which is lower than the second quarter. And I believe at that point, economists had expected faster GDP growth, which did not materialize. One of the reasons highlighted by the government was the poor weather conditions, which, of course, had a negative impact on government consumption because they weren't able to deploy as much funds as they would have wanted. And consumer spending, of course, was also negatively affected by the poor weather conditions. Okay, aside from that, we had a very disappointing third quarter earnings season where we saw around 48% of the companies that we covered delivering weaker than expected third quarter earnings results, and even uh, those that on the headline may seem good, but if you look at the details of their earnings, um, such as the operational metrics, they were really very disappointing for us. So this is not really a very good third quarter in earning season. So investors who are looking at them would be negatively affected, or if they own the stock, there would be some selling pressure because of that. And of course, the main catalyst for the sell-off in November was the election of Donald Trump as the president of the United States. Now, you may be wondering did the market react negatively? If you look at the policies of the President-elect Trump, you would notice that he has planned tax cuts. He wants less regulations, but he wants stricter immigration policies and higher import tariffs. And the expected impact of these would be faster economic growth, but at the same time, you would have higher inflation because of more tariffs and stricter immigration policies because your labor costs would go up. Interest rates, as a result, were expected to go up, and the dollar would, of course, be stronger. So how would that impact the Philippines? Well, higher tariffs would negatively affect our exports. And as interest rates in the US go up and as the dollar strengthens, that would lead to higher interest rates in the Philippines and a weaker peso. And so because of that, the Philippine stock market reacted negatively to to Trump's election as the next president of the United States. That said, though, why do we expect 2025 to be a better year for the Philippine stock market? Well, there are many reasons. First being our positive expectation on inflation, that we expect it to stay benign. The BSP is expected to be in an easing cycle or is expected to continue cutting rates. Um, 2025 is going to be a midterm election year, and that should give economic growth a boost. We are also expected to benefit from the passage of FDI-friendly bills. And as far as the negative impact of the Trump's election as the next president, we feel that the market's reaction is a bit overblown. And finally, um, while we understand that there are a lot of challenges facing the stock market, we believe that these negatives are largely priced in. So anyway, I think the most important factor that has been the elephant in the room for so many years already is inflation. And, finally, I think, with much confidence this year, finally, I believe that this will be the year that inflation would head lower. Um, if you look at the left-hand side, you would notice that inflation has been heading lower. But then again, the reason why there was a lot of hesitation or uncertainty as to the longer term trend of inflation was because of elevated food prices. You can see the main reason why, the headline inflation, which is the blue bar, is acting the way it is. It's because of the heavy influence of food, given its weight in the inflation basket. And one of the reasons why food inflation has been going up is because of rice prices. So you can see from um, benign increase in the early part of 2023, rice prices shot up in the second half. And the increase was due to the El Nino weather phenomenon and the decision of India to ban the export of rice. But then, as you can see now, rice inflation, even though you can see that inflation here is picking up in January, rice inflation continues to go down and is now at 0.8% year on year. We expect rice prices to stay benign in 2025 because El Nino is already over. As you can see here, the news says that La Nina already started last year, in July of last year. And recall that in July 8th of last year, the Philippine government reduced the tariff of on imported rice from 35% to 15%. So that would already lead to lower imported rice prices. And finally, in September of 2024, India curbed its rice export ban. So India is now allowed to export rice, and this is expected to lead to higher supply. So if you look at the prices of rice in other countries, it has actually gone down already. The price of imported rice has gone down, and that should really help the Philippines and inflation in the Philippines go down. Okay, and another good news is, interest rates. So that this is the other elephant in the room. Of course, we always talk about interest rates. We've been talking about interest rates the past few years. And for 2025, since inflation doesn't seem to be a problem anymore, we are quite confident that the BSP will continue to cut rates this year. So there. Since August of 2024, the BSP has cut rates by a total of 75 basis points. And on top of that, they've cut banks' reserve requirement ratio, or triple R, by 250 basis points, increasing the liquidity in the system. So for 2025, I think everybody is worried as to whether the BSP would continue to cut rates, because we know that the Fed has become more hawkish. However, the BSP governor has said that he thinks that there's still room to cut rates in 2025 as inflation continues to go down. It said that maybe 100 basis points is too much, but zero would also be too little. And aside from that, I mean, we took a look at the spread between inflation and the BSP rate. Historically, the spread has been closer to 50 basis points. So right now, the the BSP rate is at 5.75, and next year's inflation is expected to be at 3%. So the spread is really quite substantial right now at 275 basis points. So yes, I agree with the view that the BSP would most likely be cutting rates in 2025. Another factor that will boost economic growth in 2025 is the midterm elections. So since the 1990s, if you look at this table, you will notice that during midterm elections, the median GDP growth is 6.1%, which is faster than the median GDP growth of 5.1% during non-election years. Average GDP growth was 5.4%. This is also higher than the 4.2% average GDP growth during non-election years. So that should give the midterm elections happening this year should give GDP growth a boost. And the explanation for this is because the politicians who are running for office will spend more, will give money as they campaign to run for office. And they also spend on high-profile infrastructure projects to boost their chances of being re-elected. Okay, and another reason why we are quite excited, or what has changed, is because of the passage of investment-friendly bills. And one of them is the Create More bill. This is an improved version of the Create Act, which was passed in 2022. But as I'm sure you would know, the passage of the Create Act was unable to generate more FDIs. So right now, there are over 4 trillion pesos or $68 billion worth of FDIs that are expected to materialize because of the passage of the Create More Act. So this $68 billion is substantial given that I think we're getting around 10 to $12 billion of FDIs on an annual basis, and that is on a good year. So 68 billion is substantially more than that. And right now, I think there is an opportunity for the Philippines to attract companies that are moving out of China to avoid the steep rise in tariffs out of the US. Okay, so what are the major changes in the Create More Act that would help us attract all these investments? Well, the first is the extension of the maximum duration of tax incentives by another 10 years, from 17 years to 27 years. The next is the reduction in the corporate tax rate to 20%. Now, previously under the Create Act, the corporate tax rate would be reduced to 25%. Unfortunately, at 25%, our tax rate would still be higher than the other countries in the ASEAN region. But at 20%, we are actually very competitive. We are at the lowest end of the tax rate in the ASEAN region. Then we have the 100% additional deduction on power expenses. So previously it was 50%. So this would make the impact of the high power cost less significant on the investors. Another complaint that the foreign direct investors have is the difficulty to get their VAT refund. So they're reducing or streamlining the VAT refund process by reducing the documentary requirements. And then another improvement is the imposition of one local tax on registered business entities in lieu of all other local taxes, because of course we know that doing business in the Philippines requires dealing with a lot of signatures, a lot of LGUs and agencies trying to collect taxes and compliance, etc. And for the BPOs, the good news is they can adopt flexible work arrangements, even though they are located inside economic zones or PEZA offices and free ports. In the past, if you are located in a PEZA zone, and then you have flexible work arrangements, you are not entitled to to any more benefits. So now they have changed that. So it should help, the BPOs continue to expand or help the country continue to attract more BPOs. And then another favorable development is the bill that looks to extend land leases for foreigners from 50 years now to 99 years. So I think this one, because, when we were talking among the analysts about this, because one of the rules that we have is allowing foreigners to own up to 100% of renewable energy companies. However, when, we were talking amongst ourselves and, we talked to George Ching, our power analyst, and he said that, yeah, the foreigners are allowed to own 100% of renewable energy companies, but the problem is they can't own the land anyway. So it doesn't mean anything for them because how are they going to build up their plants if they don't have any land? So now, I think this development will help attract foreign investments in the power sector. In fact, earlier on, I talked about 4 trillion pesos in FDIs that are expected to come in. There are actually a lot of applications already for investments. If you look at the news, a lot of them are in the green lanes for approval, and a big chunk of them are actually renewable energy companies that are planning to invest in the country. And I think this development is another thing that is making it attractive for them to pursue their renewable energy projects in the country. Okay, now speaking about Trump, we feel that the market's reaction is a bit overblown. Under Trump 1.0, the first year of his office, the Philippine market actually went up by 25%. So Trump wasn't so bad anyway. The impact wasn't so bad. And remember, during his first year in office, he also implemented um, tariffs. He had a trade war with China, but notwithstanding that, the Philippine market still went up. Did inflation go up during Trump 1.0? It did not. If you look at it, the average inflation during his first term in office was 2.1%. That was during his first 3 years because the final year was during the first year of COVID, where inflation was actually lower. And then the US bond rates were going down at the same time. Or at least, it ranged from 1.3 to 3.3%. And during this time, remember, the Fed was in a rate tightening cycle. Okay, and finally, we'd like to highlight that the Philippines is less vulnerable to a possible trade war that would happen under Trump 2.0 because we are not an export-dependent country. So we are a domestically driven economy with household consumption accounting for more than 70% of our GDP. Okay, so we understand that right now there are numerous risks prevailing. So in the short term, we feel that, fourth quarter GDP might disappoint again because remember in the fourth quarter, we suffered from a lot of typhoons. Right now, we're also seeing US interest rates that are increasing and the dollar being strong. And well, there are concerns that our OFW remittances could be negatively affected by the deportation of illegal immigrants and the taxation of remittances from the US. US economic growth, in my opinion, could also slow down initially as Trump focuses on efficiency. And if that happens, the US stock market could suffer from a steep correction due to its expensive valuation, and the Philippines could suffer from a contagion. Okay, so first, fourth quarter GDP could be hurt. As I discussed earlier, the third quarter GDP was somewhat negatively affected by the typhoons. But here you look at the fourth quarter of 2024, we had Typhoon Christine, Typhoon Leon, Marce, Nika, Ophel, Pepito, and you can see that the number of people affected and the size of damages to agriculture and infrastructure are significantly more than what they were in the fourth quarter of last year. So the year-on-year comparison will not be good. Third quarter also, the damages are much higher. So there is a chance that the fourth quarter economic growth could be weaker because of the size of damages and the amount of people that were affected. Okay. So next is that interest rates are going up right now. So right now, the market is expected to the Fed to cut rates by only 25 basis points in 2025. Previously, the expectation was 100 basis points worth of cuts in 2025. And the expectations have diminished because the Fed has said that, um, they have to look at the data coming out. Uh, they will be very data dependent, and they saw how the inflation numbers being stronger than expected the past few months, plus of course the expectations of a stronger economy under the Trump administration. So now they're saying, yeah, we'll be a little bit more data dependent going forward. Okay, and this is also reflected of course in the US bond rates that have been going up. You can see how the bond rates have reached like the 10-year US bond rates have increased to around 4.8% at one point, the past few weeks, and the dollar reaching its highest since 2024. And, a strong dollar and higher rates are not good for the Philippine stock market. Okay, and then the OFW remittances, well, of course, there are talks that the stricter US immigration policies could negatively affect these remittances. So according to the Philippine ambassador, there are about 300,000 illegal immigrants in the US. And in 2022, around 4.1 million PhilAm resided in the US, and 41% of remittances in the Philippines came from these Filipino immigrants. But anyway, my feeling is this is a small risk because if we take these numbers into consideration, 300,000 out of 4.1 million is less than 10%, and most likely being illegal immigrants, the value of their remittances are much less than 10% of the 4.1 million, and 10% of 41%. So I think probably at worst that would be a 3 to 4% impact on remittances. Anyway, so more concerning for me is the potential that US economic growth would disappoint in the first year of the Trump administration, as Trump may initially focus on cutting costs. So remember that Trump is setting up the Department of Government Efficiency, or DOGE. And what they plan to do is, of course, to cut government spending. And we know that one of the reasons why economic growth in the US has been strong the past 2 years is because of the increase in the spending of the Biden administration. And then one of the officials, the Treasury official that President Trump would like to assign is Scott Bessent. And he is targeting to reduce the budget deficit from around 6 to 7% right now to 3%. And if he does that, it would require, as it said here, massive cuts on spending, and that could include anti-poverty programs, which would negatively affect economic growth. Anyway, so the risk is the market right now in the US is trading close to 22 times PE. So you can see that versus historical, it is at the upper end of the range, making it vulnerable to a correction. And if that happens, historically, the Philippines has suffered from a contagion every time the US market drops. Okay, but why do I remain positive? Well, I think, a lot of the negatives are priced in. I think a lot of investors right now are already very worried of the negatives that could happen, to the point that if you look at this, we are trading back at 9.7 times PE, which is close to the lower end of the pandemic low in terms of the PE. So that's really a very cheap level for the market. So this is around 2 standard deviations below the historic average of 15 times PE. And even if you look at the individual stocks, they are all trading at very cheap valuations. So if I look at the target for the PSEI by end of 2025, we've come out with different targets ranging from just focus on the 8% EPS growth that is projected for 2025 to the -1 standard deviation PE multiple of 13 times, a bottom-up target. You can see the upside potential is quite significant under all scenarios. So our base case is a PSEI target of 8,100, which is based on 13 times PE or -1 standard deviation of its historical average. Okay, so let's talk about strategy. So our recommended strategy is a barbell strategy. While we recognize that there are a lot of risks out there, which is why we're still recommending a more defensive strategy where, you know, you should still have some cash so that in case the market sold down, you stand to benefit and buy while stocks are cheap. And of course, having more defensive stocks, more income-oriented stocks such as REITs. We're also recommending to buy some cyclical issues that could benefit in case the market goes up, such as banks and consumer stocks. So you may be wondering why we don't have any property stocks, because these are cyclical issues that would benefit in case the market recovers. The reason why we're not including any property companies is because the property sector right now is suffering from a lot of oversupply. So if we look at listed companies take up sales, which shows how much property they are able to sell, you can see that this has turned negative. Okay, during the third quarter, it's actually down by around 14.8%. For the first 9 months, it's down by 11.6% in terms of value. And according to Colliers Philippines, it will take around 5 years to unload the excess supply. So 2025 will not be a good year for property developers. Okay, so here are our stock picks in the different sectors. So as I mentioned earlier, we have some defensives like power, telcos, and even the REITs. We have C-REIT, which is defensive. So for the REITs, I just want to highlight A-REIT because A-REIT has been performing quite well lately. And one of the reasons why this is happening is because it is expected to be included in the PSEI index coming this February. So I would like to tell everyone and remind everyone that when this happens, please take advantage of it to sell your A-REIT stocks. Because most likely after it's included in the index in February, the share price would go down first. So wait for it to happen. And then when the price goes down, then you can buy back your A-REIT stock. So right now, I'd like to focus more on the banks and consumers. So you may notice that we've added Metro Bank and Security Bank. So Metro Bank is part of the big three banks, and it will be one of the major beneficiaries of stronger loan demand. And one of the things that I'd also like to highlight about Metro Bank is that it provides good dividends. As you can see, the dividend yield is 4.2%. And it might actually even surprise positively because one of the strengths that Metro Bank has is that it's more liquid, meaning a larger part of its deposits are not yet deployed. And secondly, its capital adequacy is very high, which gives it greater room to pay out more cash dividends. So we've added a smaller bank, Security Bank, and the reason why we've added it is because as interest rates go down, smaller banks are positioned to benefit more from falling interest rates, whereas the big banks are not as sensitive to falling interest rates when it comes to net interest margins. So for the consumer companies, we believe that consumer spending will increase because of the factors we've talked about, such as falling interest rates, higher election spending, lower interest rates. We've added pure gold because pure gold has pure gold and SNR, which will help it benefit from an increase in discretionary spending. And aside from that, you can see how cheap the valuations are. It's just trading at 7 times PE, and it provides an attractive dividend yield of 3.5%. So in case you would like to see our stock picks or look at them according to themes, we've separated them according to the different themes that we're seeing in 2025. So first is the peaking of interest rates, the search for income as interest rates start to go down. If you want to be more defensive because of the many risks, we've separated the stock picks here. If you want to benefit from the improving outlook of the economy, these are the stocks to buy. And companies with attractive bottom-up stories are the following: AREIT, Jollibee, Globe, and Converge. So in summary, so in 2024, we had a volatile year where, economic growth and corporate earnings suffered from the lag effects of high inflation and interest rates. So stocks were also very volatile. They were also sold off due to concerns that the Philippines would be a major loser under the Trump presidency. But in 2025, we're more optimistic because of lower inflation, uh, lower interest rates, and 2025 being an election year, which historically has been good for economic growth. We're also very excited about the passage of the Create More Act, which we expect to lead to higher FDIs. And we believe that the concerns regarding the impact of a possible trade war are overblown since we are not an export-dependent country. Okay, and although there are a lot of risks prevailing right now, we believe that the risks are largely priced in, given how depressed Philippine stocks are trading right now. So right now, we're recommending a barbell strategy where investors buy defensive stocks in case the market becomes volatile, but also invest in some cyclical stocks that will benefit from the country's improving economic outlook. Okay, we also recommend keeping some cash to take advantage of any sell-off to buy stocks at even cheaper prices in case they're sold off because of the numerous risks. Okay, so that ends my presentation, and thank you very much. Later, we'll be answering your questions.
All right. Yeah, thank you so much for that, April. Okay, I think we're just waiting for my video to start. But while we're waiting there, okay, here you go. So it seems like despite sentiment being cloudy, there are actual real world fundamental reasons to pin our hopes on a more positive year. So kumbaga at 9.7 times PE, it looks like the price is right. I guess as Juanes is setting up, I just have a question. So the view towards a stronger market in particular, we could consider it probably as contrarian, especially given what we've seen over the past 5 years in the Philippines. And I think during the presentation, you enumerated numerous factors which could help catalyze the market to go up. So I guess for us here, given that we're pinning our hopes on a comeback year per se, which amongst those catalysts would you say is the most immediate or the single most important one to watch? So that, like, let's say, if there are people in the audience who are market timers and they're looking for a fundamental catalyst, pag nakita nila, okay, game on, we could put more money in.
Yeah, I mean, yeah, that's a good question, Serge. I mean, I was really thinking about it. Because I was thinking maybe, we could talk about first quarter being bad, second quarter being good. Especially because what if, fourth quarter earnings are bad eh?
Yeah,
But then
yeah.
I was thinking again, what if, a company releases bad fourth quarter earnings but gives favorable 2025 guidance because they'll say, oh, yeah, our fourth quarter was bad, but in the first few months of the year, we're already seeing the favorable impact of election spending come in, and our sales are already improving in January. I mean, I think investors would ignore the bad fourth quarter numbers. So I think, yeah, let's we have to pay attention to these earnings.
Okay.
And yeah, I mean, economic numbers could be, better than expected. I don't know. But definitely, it's like the third quarter. We were all initially super excited, but then when the third quarter earnings and the third quarter GDP came out, people, immediately just turned around. And aside from that, I think from a macro perspective, unfortunately, 50% of our volume comes from foreign investors. So we have to take a look at what's happening to the US dollar and the US 10-year bond rate. No, if it continues to go up and the dollar continues to strengthen, then the foreign investors will probably stay out. But that said, I just want to highlight something again because, I was looking at the net foreign selling, which is something I look at on a weekly basis. And out of curiosity, I computed how much the net foreign inflow was in the third quarter when the market rallied so strong, by 20 plus percent. Can you imagine in 3 months we rallied by 20 something percent? So the net foreign buying that materialized during those 3 to 4 month period amounted to around 35 billion. But since then, we've been in a net foreign selling situation. But the total foreign selling since then has already reached 32 billion as of yesterday. Okay. So in other words, all those investors who bought are almost completely out. So in that scenario, parang I don't think there's much anymore for them to sell. Yeah, they might sell, but I mean, think about it. The volume is so light, and then if something good happens, the market just goes up so fast. So it's really tough not to be owning anything, and especially at this point where if you really think about it, well, yeah, the markets could be volatile, but I'm being paid maybe a dividend of 3 to 4% to which is not bad because if you have a longer term perspective, most likely you will be rewarded for being patient.
Okay. All right. Yeah. Great. Thanks for that, April. So the way I understand it is the fundamentals are really all there, but to see it manifest, you have to watch like near term indicators, like if bumabalik na ba yung foreign investors, the US 10-year yield, pag nagpipeak na ba or umaatras na. But the fundamentals definitely, I think, based on what I gather from your presentation, it's there. It's there at the moment.
Yeah.
Yeah. All right. Okay. Thanks for that, April.